So our next panel will tackle the topic of the growing force of global protectionism and what does it mean for the capital flows, regulatory fragmentation and, importantly, international risk transfer. So please welcome Jake McLeod, Head of UK Crisis at Edelman, who will introduce his panel.
Here at the end.
Give everyone a second to get seated. Great, thanks so much. Yes, I'm Jake McLeod, Head of Crisis at Edelman. We're a communications and advisory firm operating around the world, based out of New York. Really delighted to be able to chair this panel today on protectionism. We were joking that I'm not sure the Lord Mayor and his team, when they decided this topic in November, knew quite how pertinent it might be by the time we get to May. But we've got a perfect lineup here to be able to discuss some of these issues. So first, I want to introduce Jared Koski, Deputy Commissioner of the Connecticut Insurance Department. He's a Senior Advisor to the Commissioner on Strategy, Planning and Policy. We have Lou Lee, who's a Managing Director leading investment, liquidity and credit risk for EMEA and APAC at Nuveen. We have David Sampson, who's the Chief Risk Officer at Lloyd's of London, overseeing risk management framework, risk compliance and capital modelling. And we have David Stark, who's our Specialty Advisor at Marshes, which is a leading risk advisory firm. So we've heard a lot already about geopolitics and risk in the current situation. I think I just want to open it up really to you all with a big picture question, which is how is rising protectionism, be it tariffs, regulatory nationalism or constrained cross-border capital flows, impacting your organization's risk outflow right now? Maybe I'll start with David.
Sure, thank you, Jake, and good morning, everyone. It's a pleasure to be here. I think there's a couple of things I'd say, and I think it's slightly tempting to think that this whole debate around protectionism has just happened in 2025 because of all the excitement over the US tariffs, but we have seen this trend now for some years. And in Lloyd's, we're licensed in 80 territories. We do cross-border business in pretty much every other country around the globe. This is a trend that we have seen, and we have seen it in multiple places, and we've seen it across many different areas. So we have seen restrictions around cross-border flows of capital, for example, of data, and of course of people and operations. I mean, if you take capital as an example, I mean, one of the things that we have started to see much more of is tighter restrictions around collateralization. So India would be an example of a territory that's just tightened that up. Portugal would be another. So this is requiring local insurers to put more collateral in place if they cede their risk to foreign reinsurers. It's these type of restrictions that make it much harder to do business cross-border. I think on the data side, you're seeing more territories requiring onshoring of data in their local jurisdictions, or I guess it's in their sort of local bit of a cloud, whatever that quite looks like. And from a people and operations perspective, we have had to put more people in more places on the ground, not least, of course, in Europe, since we left the EU. So this is a trend. It's not a new thing in 2025. If I put that in Lloyd's context, just to bring it to life a little bit, the vast majority of our business, almost 90% of it, comes from outside of the UK. And that business, that premium, comes into Lloyd's, comes into the London market because of all the advantages and attractions we have in the UK. So that's our legal code, that's our robust standards of governance, it's certainly our high quality regulation, and it's to access that specialist underwriting and broking expertise we have in London. But that business doesn't have to go to London, it can go to other places. And if in general it is harder for that premium and capital investment to flow, one of the biggest risks I worry about in this debate is that it will just gum up that flow of international insurance business. I mean, if I take the US, for example, I mean, US is our biggest single market. There is a whole market in the US, the surplus lines market, that exists for foreign insurers like Lloyd's to provide that extra capacity to businesses, customers in the US who might not be able to get that coverage in their local domestic market. So that's great if that business comes to London. It's also really fantastic for those local businesses so they can get additional cover. So anything that restricts that, I think, is a massive concern. So that's the first thing I'd say. And then I think secondly, and just a bit more broadly, I mean, if we assume that protectionism is going to result in reduced growth, lower GDP, maybe even economic, I don't think we're allowed to use the word recession, are we? Depression, maybe would be better words. Then one of the things that certainly I worry about is that we see a reduction in demand for insurance, particularly the type of specialist commercial insurance that we write at Lloyd's. Yeah, we were talking about cyber insurance before, and that is a fantastic product with the leader of that product in London. That's the type of insurance that a business who's going through economic difficulties might look at and say, this is just a luxury, I can't afford this. And yet there's probably never been a better time in the uncertain world that we're living in to demonstrate the value of that type of insurance. So if we see reduced demand, I think that could, as an industry, be a real challenge for us. So those are some of the things that sort of keep me awake at night.
That's really helpful. Jared, there was a few bits in there that I felt like touched on you a bit of.
Well, you didn't bring the American here just to talk about tariffs, did you?
No, definitely
no.
not.
But no, I think it's certainly with the topic, it's a good point to bring up now. As an insurance regulator, obviously the U.S. is a state-based system of insurance regulation. We at the various departments of insurance throughout the United States, we collaborate through the National Association of Insurance Commissioners, don't often weigh in on tariffs, tax policy, but we do speak out and address the impacts of policy. And I think as it relates to tariffs, I think it's always important to note that the price that policyholders pay in their premium is reflective of the costs associated. Let's take auto and homeowners as an example. The cost to repair and replace. And when policies come into play that impact the underlying costs following a fortuitous event, either a car accident or damage to your home, that cost in the end does get pushed back onto the consumer via their increased premiums or costs to repair. The other thing we always note too is that insurers are large institutional investors, leverage returns to supplement premiums when paying out insurance claims. So to the extent public policy or taxes impacts capital markets and investments, we do take note of that. So there are, as with any policy, there are underlying consequences and results to that. So again, while we don't weigh in specifically on those policies, we do want to speak to the impacts and advise people of what those impacts can be, and especially, again, with our mission at the insurance department is consumer protection, letting people know that when there are policies in place, again, that impact the cost, the underlying costs for this do get pushed down to the consumers, and it's something that is a concern to us.
Great. And Lou, was thinking about your role as kind of asset manager and how you're feeling about these big picture trends and concerns around protectionism.
I really echo lots of things that David mentioned. As a global organization, I think we share the similar challenges in terms of operations on the ground and how do we put the people in different jurisdictions. Do we have the right legal structure set up in each jurisdictions to facilitate the investment vehicles and we put in place? And in a similar way, thinking about the insurance revenues and premiums, we are quite sensitive to the investors' sentiment. So yes, it's been going on for a while, but the recent hike really kind of highlighted this concern from investors' perspective. So we do see quite strong evidence that investors are taking a much more cautious approach in thinking about when do we allocate the capital, where do they allocate capital, what are the potential risks are, and as CROs, it's our fiduciary duty to look after the best interest and safeguard their financial and non-financial interest in the long run. So that is quite kind of things that we really need to work as a partner on. Of course, there's the market shocks and performance and supply chain disruptions, but one of the things I feel is worth to mention, I feel the market is not putting enough weighs on is to underestimate the risk of currency movement. So we have seen quite a bit in the last few months, and unwind it back a couple of years, like a post-COVID. And we, across the globe, many countries had similar level of inflation pressure, and then, kind of interest rate across globally has seen an increase because we have to tackle that problem. And with all the different tariff regimes, different jurisdictions, different countries start to experiencing different level of inflation pressures. And so as a result, the central banks start to adapting different strategies to tackle this, with some is focusing on domestic growth. So this divergence of monetary policy we see is going to lead much higher volatility in the FX market. The reason I'm saying this is so important is it's not just FX risk on its own. If you're thinking about each asset classes that we invest in across the board, taking real estate, for example, if you're a real estate investor, we did some risk analysis looking at what is the biggest risk factor affecting real estate funds' performance over the last decades, that when we have the data. And the biggest negative contributor is not vacancy rate, it's not yield movement, it's not rental growth, it's actually currency movement. So this is kind of because it's embedded on the whole platform, but the impact of this is quite significant. And with the current divergence of monetary policy, we see that it's going to heighten, and then so it's a need to look at, okay, do I have the right FX risk management strategy in place, and how we navigate that in the midterm.
It's so interesting because obviously protectionism's changing so much of that, exactly as you outline, and the fluctuations and the over impact that the US can have across the world, who are obviously the news of it at the minute, but I guess, as David said, not the first and not the only one, certainly. David, you've been advising risk at Marsh's for 13 years. How much of this feels close to where you are?
Yeah, a lot of the points really resonate. So at Marsh McLennan, we're a contributing author of the World Economic Forum Global Risk Report, and it's in its 20th edition now. I'm sure many of you look at that as a sort of a bit of a foresight, let's say, on the short term and the longer term as well. And you can imagine, obviously, the organisations, the business leaders that you're part of and in your ecosystem do the same. So I think it is true that there always has been a lot of volatility, there always has been a lot of complexity with risk. It really is coming to the fore now in this environment we're in, which is a business growth environment in many economies. So the business leaders need to have risk intersecting with their strategy really thoroughly, really well considered, bringing in data, bringing in strategies, bringing in flexibility, adaptability to some of the changes that we're seeing along the way. So those kind of factors are certainly things that myself and colleagues are talking to client organisations around the world. And as was alluded earlier on, I think we should rightly be proud of the London Centre of Excellence and the Global Centre of Excellence that is insurance and risk management as well. But we need to, unpick the knitting, so to speak, a little bit. So it's obvious for business leaders the value that brings. So we're in a different market cycle now, as a lot of you are very well aware. We've seen quarterly decreases in rates. Clients are starting to look at insurance programs. Clients are, the risk hasn't necessarily changed, but the market has changed due to losses and such like. So they're looking at appetite. They're looking at the quantification of risk. They're looking at their frameworks as well. And I should just bring in there as well people strategy. So thinking of not just the second line of defence or the business leaders, but the first line of defence, the people who are taking risk decisions on a daily basis, or indeed may be impacted by some of the risks were they to come into being. So having that agile, really well thought through risk and resilience strategy is so important for every organisation.
Thanks, David. And we've got some questions coming in as we go, so I think we'll just take them. AI is going to come up a lot today, so that is buzzword. It feels like 2018 when we said Brexit all the time on panels. AI is the new version. But I think there's been a really interesting opportunity, and we are doing this certainly in Edelman, is the role that AI can play in processing big data. And when we're looking at risk, there's so many factors to that. I wonder if you or your companies are doing anything in this space to, as you said, David, have foresight, plan ahead, and how can maybe AI make that easier or harder, or anyway, but yeah, you mentioned it last, David, happy to turn to you.
Well, maybe just pick up on that point. So thinking about protectionism, thinking about value chains that organisations have, we talk about spheres of influence, and the sphere of influence of your own value chain, where your operations are, where your people are, is complex in its own right, but is more manageable, let's say. There's a degree of predictability in certain mechanisms that we're seeing coming from government policies. But we go to the next layer of complexity, which is the supply chain. Now, again, the first tier of the supply chain, there should be a good line of sight because there's a commercial relationship with the entity and the tiers. But we go down to the second, the third tiers. There's a lot of talk about connector countries coming in now, such as concentrations, let's say, with it, be it manufacturing or services. Mexico's often given as an example, Vietnam, or a bit closer to home, Hungary. What are the implications there? And I think years ago, if we were talking even 5 years ago, to unpick a supply chain and really understand the supply chain would have been quite a manual exercise and different disparate sources of data. So ourselves at Marsh & McLennan, we're looking at AI-enabled machine learning to bring together trading data to inform where commercial relationships are, and then overlaying that with physical information such as natural catastrophe risks, reputational risk areas, to really help the CROs and indeed business leaders take that decision with the best informed data. But I will just add finally, Jacob, it's all right, to there needs to be a fair degree of over-level or rather oversight regarding the people, regarding how it plays through. And the previous speakers were talking about scenario analysis and such like, and I think that's a really good exercise to go through.
So yeah, I mean, those points around the supply chain really resonate with me, and I think one of the key risks that we think a lot about at Lloyd's, particularly if we think about our sort of marine business, is tracking those risks through the supply chain and the way in which AI can possibly help with that. We've had to be, for example, quite nimble in recent years around different sanctions regimes. That makes it extremely challenging for vessels going through different jurisdictions. Anything that can help support the tracking of that and the data flow, I think will help. I do agree you need quite a lot of governance and control around that. I think many organizations like ours are putting in these AI councils. Seems to be quite a good way of getting different functions responsible, including, of course, the risk function, to really sort of understand the use of AI across the business. We've done some interesting use cases where we've used AI to look at risk reports, including ones that are published, like your one, David, and look at 100 different reports and pull out the key risks. That is something that would take an individual several days to do. And now the AI can do it very quickly and tell you what those 100 reports put as their top 5 risks. So there's some interesting, quite specific use cases, I think, for the risk function even in how we should be thinking about that.
And Jared, just thinking about how we regulate AI and its use in insurance and things like that, are you starting those conversations? Are they way happening? Where's that at?
They are happening, and I think with a room of CROs, one of the worst things that you can have is both political and regulatory uncertainty. I hear all the times, I don't care what it is, just tell me what you're doing. It's the uncertainty that's the problem, and we heard that loud and clear with regards to AI in the United States through the National Association of Insurance Commissioners. Over the last few years, we've gotten together and looked at ways we can provide guidance to the insurance industry on the responsible use of AI. And a couple of years back, we published a model bulletin. The importance of it being, it did not create a new level of laws or regulations. What it did was it took existing laws and regulations that we have with regards to market conduct, corporate governance, and the like, and implemented them to how industry was using AI. And I think it's no surprise to anybody in the room. I mean, we're all risk adverse, right? That's why we're in the business that we're in. That when we started this process early on, we did do a survey of the industry. We began by surveying the auto and home industry, moved to life and health, property and casualty units, and saw, not surprisingly enough, that the uptake of artificial intelligence within the industry was not ahead of what you would otherwise see in other industries. And that made sense to us at the time. But it also made us look at ourselves as regulators and say, okay, is part of this because, we're all risk averse and we want to be thoughtful in how we implement it? Or is it just us as regulators? Are they concerned about what we may or may not do? So we took that challenge ahead and developed this model bulletin with regards to AI. That bulletin in the United States has been implemented now, and I think we're up to 26 states. Connecticut, I'm happy to say, was an early adopter, not the first. We were second. Alaska beat us to it, go figure. But what we heard from the industry was that they were very supportive of this initiative, again, because it provided certainty to it. The other thing I think it's interesting to note, and I think we see this globally when we see this sort of patchwork of AI regulation, is that at the time we were adopting it within our state legislatures, there was a bill in place that was going to regulate AI very broadly across all industries. And that was concerning to the insurance industry. So I was getting calls on the phone saying, what's going on with the bulletin? Have you guys passed it yet? Because what they wanted to do was then to go back to our legislatures and our governors and say, okay, we see you guys doing this over here, but this is our regulator who's responsible for what they do, and they've already moved forward with it, and it's a good framework that we can abide by and follow, and it covers us. And we were able to do that, and I think as we've seen in the US, as states have done different things with regards to AI regulation, oftentimes the insurance sector has been pulled off of that because of the work that we are doing as insurance regulators in that space. And I think that provides some comfort to the industry getting back to that regulatory certainty. Now, the one thing I will say with regards to what we adopted is that it's principles-based. It's not prescriptive. It's based upon, again, as I said, existing laws that we've implemented in other areas, corporate governance and the like. We've implemented in data security and privacy protection, and we've adopted that to artificial intelligence. And what I say to industry as we do this is, we're learning just as much as you all. And what we want to be is partners and coordinate in this place. We've adopted this framework, this principles-based framework. We want to coordinate and collaborate with you to see how you are using it. What is working well, what's not. And we've had a good relationship with this. We had a national meeting just this past March where we had one of the larger P&C companies in the United States, Travelers, a domestic of Connecticut, provide what governance framework they have implemented. And it was great to hear, it was great to learn from what they're doing, because those best practices and a principles-based framework not only helps us as regulators, but it helps the industry at large as well.
Yeah, thank you. And you mentioned a lot there about kind of uncertainty, how that influences people's thinking, and you were very keen to say everyone was risk averse, but I know that Lou is talking a lot about not only how we're managing risk, but also the opportunities within risk and in rising protectionism. Do you want to talk a little bit more about that?
Yeah, I think probably we should talk a bit more positive side and what we can take an opportunity on. There are pockets of opportunities across all asset classes, and from commodity, from natural capital, like farmland, timberland, to real estate, or even to some other public market stuff. But one of the things that really stand out for us at the moment is looking at in the infrastructure space, particularly focusing on clean energy and digital infrastructure. So first of all, for infrastructure, it's local. Once you build a wind farm, once you kind of build a data center, you can't just offshore, you can't just lift it to another location. And also thinking about the protectionism era, the government all have to prioritize those domestic control of this strategic infrastructure to protect their own interest. So this makes sort of like, politically really favored asset class in that environment. Also, there is a quite strong public-private partnership alignment on this type of investment, which encourages the co-investing or risk sharing, and together is kind of creating a really reliable regulatory environment and a stable framework on this. Actually, I have a great example like this morning when we had our speakers' breakfast this morning, and we talk about this amazing initiative led by Lord Mayor, and who is kind of instrumental to lead this amazing initiative. It's called Mansion House Accord. And this initiative basically pulled the largest 17 pension funds together, which make them a commitment of 10% of the defined contribution money into alternative asset classes by 2030. So this is a great demonstration of this healthy ecosystem created for investors and to tap their money into this asset class. Secondly, kind of this clean energy and digital infrastructure normally have a regulated revenue stream, and which is also quite long dated. This is quite well matched with, particularly liability-driven investors looking at long-term stable cash flows for insurance companies and for pension funds. The last one, which I think is super important, is that there is accelerated structural demand for these two sub-asset classes. So if we think about digital infrastructure, we talked about AI, there's explosive demand of facilitating AI, facilitating 5G, facilitating cloud. So this need lots of investment to go into that. And within the protectionism is, again, very important for countries and companies to localize their digital infrastructure for cybersecurity, to have more controls on their data. And also kind of moving on to clean energy, with all the geopolitical tension in the last few years, I think we learned a hard lesson, like in the UK, in Germany, how important it is to have adequate domestic energy capacity in such environment. So there is definitely lots of support to build up those energy generating vehicles and also to facilitate a good supply chain on these energies. And you also have to pour money into transmission of those energies and storage of these energies. So, overall, of course, that, clean energy and the digital infrastructure has its own idiosyncratic risks. But if you can manage this risk well, there is quite a lot of upside in terms of bringing in resilience, bringing performance in the mid to the long run for investor.
Yeah, that's really interesting. I think as you're talking about those challenges around ESG and particularly predictability, I wondered if all of you could maybe quickly talk about how you're thinking about foresight and predictability as part of that. Maybe David, you want to start?
I think we've talked a little bit already about stress and scenario testing, the important role of the CRO and risk to do that. I mean, I think the real value in that type of exercise is that it gets you to just sort of think round the corners a little bit. I mean, it may be less about how likely these scenarios are to occur. You can get a bit sort of tied into the models on these things. But I think for me, it's more, what are the implications? How does it get you to think about what your contingency planning might actually be if these type of situations do occur? And I think the discipline that gives the organization, even if you could argue one way or another, frankly, on the individual scenario, is really valuable. And I think, again, there's an important role for the CRO to be the person in those discussions who's saying, well, if that did go wrong, here is how we'd actually deal with that. So I think that type of thinking is one important way that you can do that.
The kind of so what, as it were.
Yeah, totally agree. And I think just to add to that as well, David, there's inevitably new stakeholders that arise when these situations occur. So undertaking the exercise is a really useful way to unearth some of those and maybe connecting dots which wouldn't ordinarily be connected. So thinking very broadly, go back to the point about the risk community intersecting in with the business community and indeed their partners as well in that supply chain. So looking at that rounded resilience approach. And, you know, at the finance function level, that line of sight on how insurance will respond if such an event were to occur. So giving that assurance around the financial safety net and looking how the balance sheet would be impacted otherwise or other financial mechanisms.
Yeah, it's really interesting the different ways that we look at risk. You said balance sheet, but also perception, employee communication, how we keep those people on, etc. So we've got the last couple of minutes. I'm going to wake everyone up with a bit of a quick fire round, which if you can all be very prompt, but I think importantly for the audience, what is the one risk that you think the industry is underestimating in terms of global protectionism? Start here.
All right. So I thought about this question quite a bit, and I'm going to throw a bit of a curveball.
Doesn't feel quick fire, Jared.
A little bit. Well, what it is because I got asked this question yesterday when I was speaking at the Association of British Insurers, and I answered with cybersecurity and AI and all those. So I want to be a little bit different.
Okay.
So this one is one that's become unique to the United States, but I don't know if it's unique to the United States. That's why I'm throwing it out there, because it may be global as well. And it is the rise of affordability and availability issues in our nonprofit communities, specifically in the areas of daycare and foster care. So much to the extent that it's putting in jeopardy the business operations of these nonprofits that provide a significant value to all of our communities. I mean, think about it, child care. And when we have insurance, affordability and availability issues, and there's all kinds of different policies, issues that are rising this, and I don't know if it's just a cyclical nature of insurance or something else, and there's something specific that we're seeing in the United States on that. That one concerns me, when that community that provides daycare services, child care services, foster care services, their operations are in jeopardy because of the availability and affordability of insurance. That one concerns me.
Really interesting. I used to work for the UN, so I'll be picking your brains on that after this. Lou?
One risk we underestimate, I mean, we talk about, the protectionism is fragmenting countries and markets. I think one thing we're not thinking enough, at least I'm trying to talk to my business partners to think more, is this going to further fragmenting facts and the truth in the long run? I think protectionism could cloud the information we rely on to make business decisions and investment decisions. Because capital flows going forward is going to be more politically driven, and also, from each nation's best interest, the economic data is going to show the national interest. So there is a risk that we all, as a market, and start to use distorted signals and data. We can have many very clever models and AI tools, and then but if we put distorted data in, we will facing a risk of widespread of mispricing of our investments and making the wrong decisions. And that's not to mention that the risk sitting with AI, for example, the AI hallucinating, and that's also compounding part of the problem and how we make the decisions. I think the challenge is how can we accurately assess the risk and opportunities in that environment.
We're not being very rapid about politics.
No, it's okay. No, it's really interesting though, and yeah, we've done a lot of work in mis and disinformation, and information warfare is the way now, isn't it? That's it. David.
Well, I'd be tempted to say that the thing that really would keep me awake at night is if we did start to see the US tariff discussions start to move into services. I sincerely hope that doesn't happen. But I might pick something a bit more practical, actually, and just to pick up, Jared, your point around the protection gap. You know, I think there is this huge opportunity, certainly for the type of business we run in London, in the insurance sector, because in this period of uncertainty, there should never be a better time for insurance. And the risk, I think, is that we miss that opportunity, particularly in London, and maybe because, you know, we just don't explain our products clearly enough to our customers. So the missing that opportunity to really show the value of insurance in the current climate would be what I would pick.
Okay.
And
Last words.
Yeah, try to be as quick as possible.
No.
So thinking long term and more systemically, I suppose, the implications to climate vulnerability, net zero, and I do agree with Lou, there are opportunities in there as well. But the systemic risk, the threat side from the climate, and also biodiversity loss as well, which require multi-agency, multi-country, multi-organisation approach to resolve. So that would be one that more is concerning, I would say, longer term.
Great, thank you so much. And that was quick fire.
Yeah, as far as the one theme I've been picking up, and it's great to be here in this room, and Lou and David just touched upon this, and it's a point I like to make too, is that the challenges are the opportunities. And as a room full of CROs, I think that's important to note. And I bring that back to the concern that I had. It's in everybody in this room's role to kind of figure out where insurance can be the opportunity, can fit the challenges that we see in our jurisdictions and globally as well. And I think we've got a room full of very bright, talented, innovative people here. That's what we bring to the global world and the global economy, is we see these challenges and we can find the opportunities in them. So everybody take that back home with you, I think, as you go forward.
Home is a lot closer for most of us.
Yeah, I'll be thinking about it on the flight back.
I really appreciate all of your time. Thank you so much, and we'll come to an end now.
Thank you so much. Thank you.